I think it's the same thing that makes most sense practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
At the annual meeting for Berkshire Hathaway this year, you introduced a special guest to the audience of 40,000 shareholders who were watching. It was Jack Bogle. Why did you want to recognize Jack Bogle?
I think Jack Bogle has done more for American investors than any other person connected with Wall Street or the investment process, because he, with a number of other people, he came up with the idea of the index fund. He wasn't the sole thinker behind it, but he was the guy that implemented it and crusaded for it. But now there's trillions of dollars in low-cost index funds. Those people are going to have better lives. They're going to have better retirements. Their kids are going to inherit more money because of Jack Bogle and his efforts.
I recommend it. I recommend the S&P 500 index fund, and have for a long, long time to people. And I've never recommended Berkshire to anybody because I don't want people to buy it because they think I'm tipping them into some side. Never. I mean, no matter what it was selling for. And you know, I made it public. On my death, there's a fund for my then widow, and 90% will go into an S&P 500 index fund, and 10% of Treasury bills. On the other hand, I'm very happy having my future contributions to a group of charities that'll be spread over 12 years or so after my death to stay in Berkshire. I think the odds are Berkshire is, I like it, but I'm not. I do not think the average person can pick stocks. We happen to have a large group of people that didn't pick stocks, but they picked Charlie and me to manage money for them 50 or 60 years ago, and so we have a very unusual group of shareholders, I think, who look at Berkshire as a lifetime savings vehicle, and one they don't have to think about, and one that they'll look, if they don't look at it again for 10 or 20 years, that will have taken care of the money reasonably well. But that, I wouldn't argue that the S&P 500 over time. I like Berkshire, but I think that a person who doesn't know anything about stocks at all and doesn't have any special feelings about Berkshire, I think they ought to buy the S&P 500 index.
If you tell me that 3% long bonds will prevail over the next 30 years, stocks are incredibly cheap.
Okay.
Because even, I mentioned that Kraft Heinz earns $6 billion on $7 billion of tangible assets. Even if you pay $70 billion and you earn $6 billion on it, that's better than having $70 billion out in 3% government. Interest rates govern everything, and if there were a way to short 30-year bonds and own the S&P for 30 years, I would give you enormous odds that the S&P is going to beat 30-year bonds. Now, we've had this period of extended long-term low rates, not only here but around the world, and now it looks like we're not going to jack them up very fast. So we may be in a new world, the world that Japan entered back in 1990, and if so, stocks will, when we look back on it, will look very cheap. But this has not been the history of the United States to have these continued low interest rates. So if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Well, that brings us to a question that a viewer wrote in. This is T67. Piyush Pant says, from the annual report in the 13F, it looks like Berkshire was the least active in the public markets in the quarter when the stocks were the cheapest. You also did fewer buybacks in the fourth quarter when Berkshire was cheaper. Was taking the foot off the gas in the fourth quarter a conscious decision? And based on what you just said, we got all these signs that look like the Fed was not going to be raising rates in the fourth quarter, too. So why wasn't that a buy signal for you?
Well, I thought stocks were a buy in the fourth quarter, just like they did in the third and second and first quarter. But sometimes we have other things in mind, too, that may use a lot of money. And sometimes they work out and sometimes they don't. But
what does that mean? You were holding your cash in case a deal came through?
We had at least one deal possibly that would have been very large. And I liked stocks in the fourth quarter, but I would like buying a business even better.
Is that deal?
And incidentally, I did say in the annual report that we expect to be net buyers of stocks in this year. We have not been net buyers, I should point out. I mean, the market's gone pretty much straight up. I still think stocks are more attractive, but I have trouble buying it when every day it's up.